Good morning. Today we're talking about iron ore, the foundation of our modern world. This reddish-brown rock is the key ingredient in steel, which is everywhere. Cars, skyscrapers, bridges, even your washing machine. The price of iron ore ripples through the global economy, affecting everything from construction costs to the price of consumer goods. When prices rise, so do costs for businesses and consumers. When they fall, it can signal a slowdown in global growth. For years, one country has driven this market, shaping global supply chains and international politics. Today, we'll unpack what's happening in the iron ore market as of early 2026, key players, shifting trends, and what the future might hold. Understanding this market reveals the hidden forces behind the cost and availability of goods we rely on every day. The journey from raw ore to finished steel is a global feat of engineering and logistics, involving massive mines, ocean crossings, and giant furnaces. Any disruption, policy changes, new mines, can send shockwaves through the system, impacting prices and supply worldwide. When it comes to iron ore, China is the main story. Its rapid urbanization and infrastructure boom made it the world's largest steel producer and iron ore importer. The world's biggest miners, especially in Australia and Brazil, have built their businesses around feeding China's demand. When China's economy surges, iron ore prices soar. When it cools, the market holds its breath. Recently, China has started capping steel production to address pollution and oversupply, signaling a shift from relentless growth to sustainability. Last year, China's crude steel output dropped by about 5%, a sign of this transition. At first glance, this seems bad for iron ore, but the story is more nuanced. Not all steel is made the same way, and how China makes its steel now matters more than ever. The real impact on iron ore depends on the production methods used. As China manages its steel sector, the world is watching to see if this is a pause or a new, stable phase. Despite the drop in steel output, the demand for iron ore remains surprisingly resilient. To understand why, we need to look at how China's steel is made. The details of production methods are now shaping the future of the iron ore market. China makes steel in two main ways: blast furnaces using iron ore, and electric arc furnaces (EAFs) using recycled scrap. Only blast furnaces consume large amounts of iron ore. Last year's 5% drop in steel output was mostly from EAFs, not blast furnaces. Pig iron production, the iron ore-intensive method, fell just 2%. So, even as total steel output declined, demand for iron ore stayed strong. In fact, China's iron ore imports actually rose by 2%. Mills favored blast furnaces, keeping demand for raw ore high. This helped absorb increased global shipments and kept port stockpiles stable. The result? A market that looks like it's cooling, but is actually holding steady beneath the surface. The way China cuts production, focusing on scrap-based steel, has cushioned global miners. It's a reminder that the details of production matter as much as the headline numbers. While China drives demand, global supply is shaped by a few giants, mainly Australia and Brazil, with South Africa also playing a key role. Last year, these countries increased shipments by over 2%, adding 30 million tons to the market. More supply usually means downward pressure on prices, especially if demand isn't growing as fast. But it's not just about the big exporters. China's own iron ore production fell by nearly 3%, and India's exports also declined, offsetting some of the new supply. The market is a balancing act, rising output from giants, shrinking supply from others. The result was a well-supplied but not flooded market in 2025. But a new player is emerging that could change everything: Africa's Simandou mine. This project promises to reshape the global supply map and add a new dimension to the iron ore story. The arrival of Simandou could mean more competition and a shift in global trade flows. The market is watching closely as this new source ramps up. The supply side is entering a new era. The Simandou mine in Guinea is the world's largest untapped high-grade iron ore deposit. After years of delays, it's finally shipping ore to China, marking a major shift in global supply. Simandou's high-quality ore needs less processing and produces fewer emissions, a big plus for steelmakers and the environment. As production ramps up, it will add a massive new stream of supply, giving China an alternative to Australia and Brazil. This diversification is strategic for China and introduces more competition among global producers. Simandou also brings new geopolitical dynamics, strengthening Africa-China trade ties. While initial shipments are small, the mine's full impact will unfold over the next decade. The market is already trying to price in this future supply. Simandou signals a fundamental transformation in the iron ore landscape. More diversity, more competition, and more complexity are coming to the market. The world is watching as Africa steps onto the global stage. With China's demand cooling and global supply rising, iron ore prices have slipped, down about 3% last year. The market is now well supplied, shifting from scarcity to adequacy. China's new centralized purchasing group, CMRG, is consolidating buying power and negotiating as a single entity. This has reduced price volatility and given China more leverage. Instead of wild price swings, we're seeing a more stable, less profitable environment for miners. The combination of steady supply, moderated demand, and China's strategic buying is keeping prices in check. The question now isn't about shortages, but about the price at which all this ore will be sold. The market has matured, moving from frantic growth to careful management. Even as prices drift lower, there's a limit, what experts call the cost floor. If prices fall below production costs, high-cost mines shut down, tightening supply and pushing prices back up. Morgan Stanley estimates the 90th percentile of global production costs is around $80 per ton, with some mines costing over $100. If prices drop too far, these high-cost producers exit the market, creating a natural price support. This cost structure means a total price collapse is unlikely. Rising fuel costs or a weaker dollar can push production costs and the price floor even higher. The market's resilience comes from this built-in support. We may not see the highs of the past, but a return to rock-bottom prices is also unlikely. The industry's higher cost base now underpins the market. Understanding the cost floor is key to seeing why iron ore prices remain more stable than they appear. So, what's ahead for 2026? Most experts predict stability, with prices under some pressure but anchored by strong cost support. China's steel output will likely stay constrained, but the blast furnace method will keep iron ore demand steady. Morgan Stanley forecasts an average price of $100 per ton for the year, slightly above consensus. They expect a price dip to $95 in the third quarter as new supply, especially from Simandou, peaks. After that, prices should recover and stabilize. Risks remain. A sharper slowdown in China or major supply disruptions could swing prices. Geopolitical events and energy costs could also shift the outlook. But the base case is a well-balanced market, with disciplined buying and cost support keeping prices in a narrow range. Iron ore's story for 2026 is one of resilience, not runaway growth. In early 2026, the iron ore market stands as a model of resilience. China's shift to sustainable steel hasn't dented its appetite for high-quality ore, anchoring global demand. On the supply side, established giants remain strong, while Simandou's rise promises new competition and diversity. The market's cost floor acts as a safety net, making a dramatic price collapse unlikely. The fundamentals of mining ensure iron ore retains its value, even in a well-supplied world. The key trends to watch: China's economic pace, Simandou's ramp-up, and global energy costs. Iron ore may not make headlines, but its quiet strength shapes the world we live in. Its future is one of stability and enduring importance.